Alright guys, welcome back to the channel. In the last 24 hours, Bitcoin has broken through $100,000, closing the day out at 102, just 6% away from a new all-time high. However, we're also hearing about the yield curve. This time, it's uninverting. Is this going to lead to an economic collapse? Something that we've been told about for the last 3 years, and it has not occurred. However, we're going to look at the data in today's video. What does it mean for the stock markets, the economy, and Bitcoin on your home of macro cycle analysis with me, Jason Pizzino. Been trading and investing for over 18 years, starting with real estate, then into the traditional markets, trading commodities, and then Bitcoin and crypto through from 2017. So make sure you hit the like button and subscribe to the channel if you are new. Links in the video description for channel sponsors. I'll cover those later, but the big one in the next 24 hours is the free crypto and economic report coming out to your email. So that's the link in the top of the video description. So the big questions I want to answer today, we're looking at the yield curve. We're always told about some sort of economic collapse that occurs when the yield curve inverts and then uninverts. And this is the longest one in history. So the longest time the yield curve has been inverted for and now becomes uninverted. So what happens next? We're going to take a look at what the data suggests. The Bitcoin breakouts and fakeouts, looking at that data over the last 2 cycles and seeing what we can take from that for this particular cycle. As I said in the intro, Bitcoin approaches that all-time high at around 108K. And now we find ourselves set with volatility in this final phase of the 18-year cycle. Now, I want to start the video with a fantastic quote. Peter Lynch is one of the greatest hedge fund managers of recent history, and I think it's important to remind ourselves of this, at least remind myself of this. Unless you are a short seller, it never pays to be pessimistic, which means the long side of the market generally wins overall. And I think it's also an important one to remind ourselves of, just because we're talking about something that might happen in the future and that might be a downside to the market. Overall, when you look at the data over the last 100+ years, it never pays to be pessimistic. And as we can see over this last bull market, all we have seen are most people being very pessimistic, looking for tops, trying to short tops all the time. That is not the game that I'm playing. That's not the game that I talk about here on the channel. We're looking at longer term. However, in this final phase of the market, we are definitely seeing more volatility. I'll mention what I'm talking about with this final phase of the cycle. But I just want to draw our attention to some of these cash levels and what brings on that volatility. Cash levels fell from 4.3% to 3.9%, a 3-year low. So this is for the Bank of America Global Fund Manager Survey, average cash level. So essentially, cash going into the markets. So it's either in the markets or away from the markets in their own accounts, of course. And you can see from these tops here, so a percentage of cash levels, they've done this at generally around the low prices. They have the most cash, and then they start to put money in on the way up. So, not everyone gets it right, and especially these cash managers at Bank of America. You can see December 08, they had some of the highest levels of cash near that low. The low came in March 2009, but essentially the prices were roughly the same at that area. They were holding the most cash. Then they decided to get into the market after that point, and then they start holding cash at the lows, April, and then they start to invest there, right? October 2022 was the low over the last 2 years, 2.5 years now, and they had the highest levels of cash at that time. So maybe they were taking profits along the way as the market was going down, but as you can see throughout the bull market, they've been starting to throw more and more money back in. Now we're at one of the lowest levels of cash. So once all the cash is in the market, new people, what I've heard anyway, is that they think the market should keep going up. But when you don't have any more buyers left and there's no more cash left, how does a market go up? That's the problem that we have, that we face at the moment with the stock markets. There's a lot of cash floating around, and of course, Bitcoin and cryptocurrencies. So this is one reason, at least why I'm seeing, as to why we're going to see extreme volatility in the winner's curse phase. Yes, we are somewhere around here. Don't worry about where the yellow dot is. As long as we are in this winner's curse phase at this stage, that's where we currently sit. And that pretty much comes out somewhere around late 2025, sometime into 2026. And remember what we're reviewing here: house prices, the economy. This isn't necessarily the top of the stock markets, but in terms of house prices and the economy. That's a big one that I often see very, very confused, especially in the comment section. So we're looking for some sort of top, but there still could be 12 months. It could be 24 months in the market to go. No one knows for sure, but what we do know is that we are seeing further volatility, and that is obviously because of the cash in the markets. As you can see, a lot of people are putting cash in, taking it out, putting it in, taking it out, and that is leading to those wild swings. And how is that happening? Well, we're seeing an era of very easy money. So this is the original here from Akil, who's put this chart together, and we've redone it here so it looks a little bit cleaner and fresher there, but it hasn't changed. As he said here, from 2016, we're in a commodities boom. We've seen commodity prices go up. Cocoa's up, coffee's up, natural gas is going up. Oil has started to tick up a little bit here, but you're looking at gold, a commodity is up. You're also seeing cattle at new all-time high prices. So they're all commodities. They're commodities that we consume, and that essentially leads to inflation as well. We're also seeing huge infrastructure spending. Remember, this was reposted in 2023 at a time when most did not believe the market was going to go up. This is before the banking crisis as well. And everything has continued to play out as, I guess, expected, quote unquote. World's tallest buildings being announced. I saw an article in the last 24 hours from our members in TIA Premium, looking at the world's tallest buildings in the UK going up, or at least the tallest buildings in the UK for a very long time. And you don't often see these announcements at the lows of the market. You see them coming in towards the top, which is your winner's curse phase. A lot of money floating around, the volatility increases because a lot more people are getting into the market. It's just like an altcoin market when you get towards the tops. There are wild fluctuations in the prices of that asset. So that's where we're seeing a lot of commodities hitting new all-time highs. I don't think that's going to end this year. Some might, but the majority of them I think will keep going. And just as a little bit of a headline example here, trader who made billions in 2008 returns to bet on market swings, aka volatility. So ready to pounce on volatility again, and that is Steve Diggle's family office. Management seeking up to $250 million. Of course, this is an ad piece that Steve's put together and probably sold off to some news outlets here. Obviously, Bloomberg's reposting it. I've seen it reposted everywhere. So I think it's just a bit of a news piece so he can try and get on $250 million. Of course, he's got his contacts out there that could invest in the fund as well. But he's looking at this as a similar time to 2005 to 2007 is what I've read in some of these articles itself. That is just a high volatile time. That's towards these peaks. 2006, 2007, that was the last peak of the last economic crisis there. So you had the peak, then you had the crisis into that collapse. So that's why I'm looking at the yield curve today. Last thing before I get onto the yield curve data is the optimism resetting to a more favorable condition for stocks. Plenty of data here to look at where this had come from and where it's gone to. Essentially just looking at how the market is resetting its sentiment for another entry opportunity before it, I think it's going to continue up. So that's why I brought up this quote here from Peter Lynch. Although we might be talking about some sort of impending doom collapse later, I still see further upside based on many of the reasons that I've just given you there, plus all the other reasons that we talk about on the channel time and time again. And of course, in more detail, I do this with the members, TIA Premium, putting together their trading plans and investing plans and making back multiples even just from August. So this is the latest one here from Flowkey. He bought TIA Premium in August 2024 during the sale we had then. Total spend $1,200 USD. I was working with 2.5 and 12, managed to get that back up. And at the moment, I've made 3x more from my trading of my total $3,700. So I truly want to thank both of us for becoming full-time traders in the future because of how the teachings are in TIA Premium. So if you are wanting to learn more about that in this stage of the cycle, as things get a little bit more volatile, link in the video description for TIA Premium. I'll leave it in the pinned comments down below as well. So that's a look at the optimism in terms of the minor reset there for the stock markets. Now, as for the yield curve, the key points here, the 10-year minus the 3-month Treasury yield curve recently returned to positive territory after spending over 2 years in inverted territory. So now it's uninverted. And this was the fear that we heard all about in 2022. When it goes inverted, we get a recession within whatever period. You know, people were looking at 3 months, 6 months, and that to me is why we were hearing a lot about we had to get a recession in 2022. We had to get a recession in 2023. We had to get one in 2024. There was no recession. And from the comments I saw, people really did think we were in a recession. But from that point, the prices went up. So when you miss out on the prices going up, then you're sort of back against the wall and you are wondering when is my time to get into the markets. And that's what leads to that extreme volatility. Another reason that leads to extreme volatility when the markets are at all-time high prices. People were too scared to buy the lows. They thought there was going to be a recession, and then they wait and wait and wait. Let me know in the comment section if that's you, if you feel like putting your name to that. But that essentially is what I've seen across social media. And I want most people to hopefully avoid that next time round, right? So the yield curve, 10-year Treasury note yield, 3-month Treasury bill yield. The chart below displays month and 10-year, 3-month yield. A lot of months here. Essentially, this is what we're looking at right here, and it has uninverted. So I want to take a look at the data now. And I'm going to take this particular section. What this is showing, the first part, after the signal, displays the performance only following the dates listed on the table above. The second part repeats what the market does in all months, so that you can see the percentage returns that, say, the stock market gets over a 12-month period. And then the third part compares the difference between the post-signal performance versus baseline performance. What we want to look at is the summary to all of these data points. The two key things to note are the economy does not always contract or perform poorly following an uninversion. And that is just taking the raw data and putting it into a key point to take away. However, the percentage of times up and average and median results are worse across all time frames following an uninversion versus the baseline. So what the stock market normally does, which is the baseline, what we see after this point is worse than that. So if the stock market does 10, 11% a year, then after this uninversion, it says it's going to be worse than that. So maybe less than 10 or 11% per year. That still doesn't mean it's going to be an absolute economic collapse, which is what this point says, but it just says it's not going to perform as well. I've got a little bit more on that in a moment. That's just looking at the pure raw data going back to, I believe it was 1976. So that's that's basically where it starts from. Now, the next part of that is a little further down. Here is the uninversion date, number of months to when it goes inverted here. So months, number of months inverted. So at the moment, we're at a 26-month period. That's what we have now got. It was 26 months inverted. We've gone to uninversion. And I want to pay attention to around the 12-month period, and you have the 24-month period from this signal. That signal came out in December, and of course, we're the first week into January 2025. Here we are again. These are all the months. You have the percentage of times after the signal. So you've got the 12 months and the 24 months. And what does that look like in terms of a difference? Well, pretty poor when you look at the 12 months. So 12 months from now, after the signal, the median percent return is, for the SPX that is 0.4%. So basically a flat year. After the signal, the average was 4.6%. And after the signal, percentage of times up. So still, you had 50% of the time the market was going up. So 1 in 2 times, not the greatest returns there. You start to extend it out to 18 months, 21 months, 24 months, then you get up to a 70% hit rate that you're going to see more positive prices, right? And even though it's a positive, you can see the median for the next 18 months, 21 months is not that great. 13%, 12% compared to the baseline. The baseline here is 15, 17, and then at 24 months it started to come down again. And that could lead us into 2027, right? It could be late 26, early 27, the market could be coming down, and you're starting to see a worse return there than the 21 months. So you got 5% return and 12% return. So it started to come down. And on a baseline here, you got 19.8%, which means it's 14.5% worse off than the baseline itself. So it's not looking great 18, even 15, 18, 24 months out from this point. Still potentially positive, but that's all I'm talking about when it comes to this rounding top. I know it looks like a point here. I could make it rounding, but essentially when you get into this peak of the cycle, running up, and then maybe we start to see that sort of rounding off top like we'd seen in the past. People are thinking, well, I've still got time here. I'm going to buy the dip. And that sort of carries on for 3, 6, 9 months, and they get a little bit screwed at the end of the cycle. They were all waiting for this dip, and then you get that complacency bounce. And from that point, obviously things are down. So just looking at the summary here, two key things to note are the stock market does not always decline following an uninversion. See 1980 and 2020. So we had the most recent one there, and 1980. Those were both mid-cycles. For you guys playing at home with your 18-year cycle, they were both mid-cycles. 1981 there, 2020. So mid-cycle, it didn't go down, obviously, because the market was still in the middle of the 18.6-year cycle. You're 14 years up, you had those, and bam, the market continued up from that point. Yes, you could say, well, 2001 did. Yep, you'd be right. Remember, it's not a 100% guarantee that the stock market has to go up at those particular times. Eventually it does. However, the percentage of times up and average and median results are worse across all timeframes following uninversion versus the baseline, except for the first month. Okay, first month right there. We're in the first month, we're in January. So maybe January starts to rise up and then we see a bit of a fall here through month 3 months from it, 6 months from it. We just don't know yet. We have to wait and see what happens this year in 2025. Just according to the data, that's what looks like happens. You know, you get this volatility. And so finally, in the results here, the good news is that the recent uninversion of the yield curve does not guarantee an impending economic recession or a bear market for stocks. The bad news is that it might. Yes, I hear you. It can, it cannot. Up, down, sideways, no one knows for sure. I think the best thing to take from this is that it doesn't mean that it has to be a collapse, and not necessarily a collapse within 6 months, 12 months, 18 months, 24 months. That is what a lot of people, analysts, media, you name it, were saying, that we had to get a recession in that period. It didn't happen. And the data suggests that it does not need to happen in this period of time. Like, it doesn't have to happen this year. Of course, I know anything can happen. But I think when we had the fact that everyone was saying that it had to happen was probably a good reason why it didn't happen. And if we get to that point again this time, the fact that it has to happen might be another good reason that it could prolong even further than many are expecting. So if you do hear anything about the yield curve inverting, then uninverting, and it must lead to a recession, well, you can reference people back to this video. Make sure you do hit the like button, subscribe to the channel so that you see more of this content in your newsfeed. Hopefully it keeps you on the right side of the macro trend, looking at the 18-year cycle here. So that now leads us to some more of the, I guess, hopium side of the S&P 500, which would obviously help out with Bitcoin cryptos as well. Solid returns are normal after a 20% gain. So what we have seen for the S&P 500 is 20% gains per year. What this is showing is the average year is 9.5% gain. Of course, we've seen massive gains over the last 2 years, 2023 and 2024, over 20%. After a 20% gain, the average return is 10.6%. That's 81% of the time you would see a 10% return. So 8 out of 10 times you're going to see another higher market. Then if you get a back-to-back 20% gain, is another 20% gain 100% of the time. So this is almost conflicting to what I was reading here off the yield curve, that this year is not necessarily going to be that great. Look at the 12 months here. After the signal was 0.4%. That's 50% of the time. Now, the other 50% of the time could be something like this. We see another 20% move. And what we had seen in the past leading up to the dot-com boom in the 90s, which doesn't show on this chart, unfortunately, was massive moves to the upside. You had very, very strong moves. So take a look at the SPX. Through 1995 was basically straight up. 1996, almost straight up. You had a few pretty dire moves to the downside. Doesn't look like it on the chart, but when you measure it out, you got a double-digit move in a pretty strong bull market there. Just this particular month, October 1997, that was 13%, so another double-digit. Then it looked like the game was all over in 1998. That's a huge 2.5 months. 22.5% in 2.5 months. Could you imagine that if the stock market did that now, just dumping for 2 months and then basically reverses and heads to new highs? That's the sort of volatility that might occur leading into this last phase of the cycle. You know, I've talked about the money and where that sits. I'm just preparing for this sort of crazy volatility towards this end stage. The thing I'm looking out for are breakdowns of the swing. And this is on a monthly 2-bar swing. So I have the monthly and 2 bars, and you start to see breakdowns of that probably things are going to turn over. You can see the breakdown, then the retest right underneath that previous support. So that could be one of those signals that tells us, well, the game might be over. You've got some pretty severe corrections here, and that has taken, don't be foolish here, it's 12 months. A move to the downside, a retest to the upside. So it's pretty long periods, but we are looking at very, very long-term cycles here. And you can see that move up lasted several years. It's 13 years. You'd have to expect a major signal will have to unfold over several months. So with all that sort of impending doom of recessions, we still have to take a look back to what's going on in previous cycles, and some of those just continue to ride higher with very extreme volatility. I think volatility now is basically game on. That's all we're going to see through these next several years, enough to shake us and then continue back in with the trend. So there's no problem with getting out of positions and getting back in, especially with that extreme volatility. Speaking of which, let's cut over to Bitcoin and cryptos now. Extreme volatility is basically a feature of cryptocurrencies. You're at 78 extreme greed now. And the big one here overnight is the USDT dominance has again pushed lower, getting a closing price of 3.9%. Still in the trading range here, still in a similar holding pattern to what happened at the top in 2021. So that's this area back here, starting from January 2021 and then crashing down in May of 2021. So roughly about 4 or 5 months. And there's still no signal that it's going to break down lower or break out higher. In terms of the short term, you can see this nice diagonal that I've drawn here. You had a retest of the diagonal and then a quick move down. That could be the end of the move. It could be the start of it. You're not going to know until it breaks 3.7, 3.8%, or if it reverses and comes back above that line. What you will know in the short term, if it does get back above 4.1%, well, probably attempting another crack at 4.2. Unfortunately, it's in a trading range. When it's in a trading range, there's not much you can really do apart from wait for the signals for the breakdown or the breakout to the upside. But as for the crypto market cap and Bitcoin, there's still a lot of strength in the charts overall. Even if there is this wild volatility, we start to rise, hit some more resistance levels, and then come back down over the coming days or weeks. The point of it here is last time we did see that happen, we had the 3 days down, we had the retest to the upside, and that got within 3% of a new all-time high. That was back in April when it bounced from the low there in March and then corrected again. That period from the top to that final test was around 25 days. So we're coming up to that now. Those first couple of tests were at 12 days, 17 days. Each of those occasions, the sentiment was we are back and we are going to 3 trillion, 4 trillion, 5 trillion, 100K Bitcoin, buy your dips. That was what was going on in March and April of 2024. Hopefully most of you remember, hopefully most of you were here and you hung on for the ride. Roughly around that 25 days, you had that final top there and bam, it came crashing down. It attempted again from the May low to the tops and then came crashing down again. So where we sit at the moment is roughly around 6% away from a new high. And for the time frames, there's the top to the current days at 21. So we'll see how this goes over the next 1 to 2 weeks based on the previous timing there, whether we do get to these tops and another retest or a breakout. Now, if there is a breakout, that's where we got Bitcoin to have a look at. Bitcoin last time, just a quick reference, it got to 1.45%, so about 1.5% from the top before it came down. And again, it was about the same time frame. Top to top was about 25 days. Came down, came back up. That was another move there to 68 days and came back down. All within that period, of course, there's a ton of emotions. People saying it's back on, buy the dip. Now it's not back on, double top and starts crashing. So that's the difficulty when you're in a trading range. I can't do anything more for you on that. We just have to continue to follow the trading range and not let the emotions distract us from what the charts are saying. If we do break out of the top, so on to the next idea here. I'm looking at Bitcoin breakouts and fakeouts. If we break out of that top, let's have a look at 2017 because there are several times here that happened. You can see the first many times, right? There's the top, correction, starts to work its way higher, comes back up, another correction. So long and short of it, the too long didn't read, and I'll go through more examples to prove the point here. It can break out into a new top. Maybe we get to 110, 112, $120,000 BTC, which potentially leads to another correction. But that's just part of the volatility of the end stage of the cycle. Remember, the bull market's been going on for over 2 years. Don't let anyone tell you otherwise. The bull market for Bitcoin started November 2022 at the low and has been going on now for over 2 years. And when you get into that final year, the volatility increases. That's basically what happens every single time. There's your January low. It broke out to new fresh highs. $1,200 was that top. And then the volatility increases towards the peak. Lots of swings up, lots of swings down. And almost each occasion, you had a top, couple of tops if you want to call it that, rejection, ran into a new top, rejection, then you get the longer move to the downside. Comes out, you had a 3 days up in that case, and then works its way to another top, rejection, works its way into a weaker top, bigger rejection, then starts to find a base, works its way higher. Great, we get a new all-time high, everyone gets happy again, $10,000, $20,000 BTC. Okay, top, rejection, top, longer rejection, yes, on a shorter term time frame, but yes, that was longer than this one here, and it works its way higher. Top, another little top here, rejection, works its way higher, big rejection, works its way higher, big rejection, big swings. That is a very, very big swing from a top, 19,000. That's a 31% in 3 days. That's the sort of wild stuff that's happening at those peaks. And that was only a few days left until the final top, which worked its way slightly higher than a big correction. So the nature of some of these moves in this final year, and that's the whole final year there. There's December 2017. You could say it started from the breakout at around $1,200. So that's about, March is the last 8-9 months. You're getting these tests to the top, rejection, tests with a weaker top, bigger rejection, tests to the top, and then another move to the top, bigger rejection, bigger rejection. So those next ones that come might be a little bigger. All I'm saying here is if we do get a weaker top that forms, I'd be looking out for a bigger rejection there and seeing if the market still has legs in it to consolidate and then move higher from that point. Now is a great time to remind myself, hopefully yourself as well, for the quote that I gave you at the beginning of the video. This is from Peter Lynch. Unless you are a short seller, it never pays to be pessimistic. That, to me, is not pessimistic. I'm just looking out for any sort of signs of weakness, preparing for any sort of volatility, which is prevalent in every single final stage of the bull market, whether it's Bitcoin, whether it's cryptocurrencies, whether it's the stock market, whether it's a real estate cycle. Volatility always occurs at the end of cycles because you see a lot of money flowing into the markets trying to take advantage of the gains that they missed out on for the several years prior. Bitcoin, they missed out on the several years prior from the lows, as I talked about here on Twitter. I said they were the lows, most likely going to be the lows, and where we find ourselves now is up over 500%. They're hoping that they get another 500% from here because of what they saw previously. But unfortunately, it's probably one of those games where you'll see less and less returns to the upside compared to what we have seen over the last 2 years. I hope I'm wrong. We'd all be mega, mega rich, but someone would have to be mega, mega poor for that to happen. It could still occur. Let's wait and see from that point. Like and subscribe. I'll be back with you the next video. Make sure you bookmark this if you want to reference back to the yield curve inversion and uninversion. And also links in the video description for our free crypto and economic report coming out today. I'll see you guys back here at the next video. Until then, take care and peace out.